Welcome to Policy on Demand. In an often complex world, the prospect of simplicity is enticing. With the introduction of the OECD's Pillar 2 Global Minimum Tax Model Rules in late 2021, calls for simplicity emerged almost immediately after their release. A lot has happened since then, with the latest development being the much anticipated side-by-side safe harbor guidance, released on January 5th. Even with the expanded safe harbors, Pillar 2 does not become simple. The safe harbors do, however, address some of the long-standing concerns of U.S. policymakers. In this episode, Pat Brown, Stewart Brant, Giorgia Maffini, and Steve Kohart share the ins and outs of the safe harbors included in the side-by-side guidance. Here are their insights.
I'm Pat Brown, and here's what you need to know about the Pillar 2 side-by-side safe harbor. So for many U.S. companies, as well as many members of Congress, the side-by-side safe harbor is the focal point of the OECD's recent guidance. Now, before I describe how this safe harbor works, there are several important issues that are vital to understand. First, the safe harbor only takes effect starting in January of 2026. No changes for 2024 or 2025. Second, the safe harbor will only go into effect for most countries when they amend their domestic laws. There has been some confusion with respect to EU jurisdictions. In the past, EU countries have generally concluded that their national laws must be amended before changes to the Pillar 2 rules take effect. This is an area that we will need to continue to watch. Third, the safe harbor does not apply to QDMTTs. As of today, over 50 countries have enacted QDMTTs. Unless these countries change their domestic laws, QDMTTs continue to apply without regard to the safe harbor. Okay, so now let's talk about what the safe harbor actually does. So this safe harbor provides that the Pillar 2 IIR and UTPR are both deemed to be zero for any members of a multinational group whose parent entity is located in a qualifying jurisdiction. As of today, the only qualifying jurisdiction is the United States. So this safe harbor effectively turns off the application of the Pillar 2 IIR and UTPR for U.S. companies and all of their affiliated entities around the world. Now, to qualify, a country must have a statutory corporate tax rate of at least 20%, an alternative minimum tax based on financial accounting income of at least 15%, and a global tax regime that imposes tax on the foreign operations of companies with no material risk that the foreign operations are taxed at less than 15%. One question that has already arisen is whether the United States has effectively committed to the OECD that we won't make any changes to our tax system relating to these criteria. For example, could Congress make taxpayer-favorable changes to the CAMT? Could Treasury release favorable regulations? Treasury officials have tried to get out in front of these potential concerns by stating publicly that they believe the U.S. system is permanently qualified for the side-by-side safe harbor. Finally, along with the rest of the package, the side-by-side safe harbor will be revisited as part of a stock take that is to be completed by 2029, which is intended to consider whether this guidance package has resulted in competitive imbalances among companies. As of today, I don't know if anyone knows what that will mean in practice. Other than that, the OECD will continue to monitor the overall effectiveness of Pillar 2 going forward.
I'm Stewart Brant, and here's what you need to know about the Pillar 2 Ultimate Parent Entity, or UPE Safe Harbor. What it is, how it works, and why it matters. At a high level, the UPE Safe Harbor is best understood as the roll forward of the transitional UTPR Safe Harbor, which expired at the end of last year. The key difference is that this version is intended to be permanent, but with much stricter eligibility requirements that focus squarely on the robustness of a jurisdiction's domestic minimum tax regime. The UPE Safe Harbor is a narrow form of relief. It applies only where a group's ultimate parent is located in a jurisdiction that has a strong domestic minimum tax system, but does not meet the broader requirements of the side-by-side safe harbor, specifically the requirement for a worldwide tax system. In those cases, an eligible group may elect to deem the UTPR top-up tax for the UPE jurisdiction to be zero. It's important to be clear about scope. The UPE safe harbor applies only for UTPR purposes. It does not affect IARs, QDMTTs, or UTPR exposure in other jurisdictions, and it does not reduce compliance or reporting obligations elsewhere in the group. It's also not relevant for U.S. parented groups, since U.S. income is already excluded from the UTPR under the side-by-side safe harbor. To qualify, the bar is high. A qualified UPE regime must have a statutory corporate tax rate of at least 20%, a QDMTT or an alternative minimum tax based on financial accounting income at 15% rate, no material risk of domestic effective tax rates falling below 15%, and the regime must have been enacted and effective by January 1st of 2026. Jurisdictions must be reviewed in the first half of 2026, with no late entry, and notably, no jurisdictions have yet been listed as qualifying. In practice, this makes the UPE safe harbor most relevant for non-US groups headquartered in countries with strong domestic minimum tax regimes, but for example, relatively weaker CFC rules. Essentially, a targeted pressure valve to prevent the UTPR from biting at the parent level. And finally, like the rest of the side-by-side package, the UPE safe harbor is subject to the 2029 stocktake, reinforcing that it should be viewed as stabilizing, but its design and operation remain open to future modification based on experience and integrity assessments.
I'm Steve Kohart, and here's what you need to know about the Pillar 2 Permanent Simplified ETR Safe Harbor and the extension of the Transitional CBCR Safe Harbor, what it is, how it works, and why it matters. The OECD's January 5th side-by-side package included a new permanent ETR-based safe harbor that has been referred to by the OECD as a down payment on simplification. While many stakeholders welcome simplifications, this new safe harbor looks a bit more like a full Pillar 2 or GLOBE computation than the transitional CBCR safe harbors that we have been working with for the past few years. The simplified ETR safe harbor is expected to be available for fiscal years beginning on or after 1 January 2027, though it may be available in some jurisdictions this year if such jurisdiction elects to legislate with an earlier effective date and certain other conditions are met. Like the Pillar 2 rules, the simplified ETR safe harbor uses 15% as the applicable minimum rate. This new permanent safe harbor is based on the financial accounting data used to prepare the multinational group's consolidated financial statements, or in some cases, its local financial accounts. Both the numerator, referred to as simplified taxes, and the denominator, referred to as simplified income, incorporate a number of mandatory and optional adjustments. Many of these adjustments are indistinguishable from the full GLOBE rules, such as denying basis for certain transition period transactions and requiring the recast of deferred taxes at the minimum rate when such deferred items have been recorded at a higher rate. Unlike the transitional CBCR safe harbor, the new permanent safe harbor does not include a once out, always out rule, but rather requires that the M&E group did not suffer top-up tax with respect to the jurisdiction for the prior 24 months. Thus, it is possible, with respect to a jurisdiction for an M&E group, to exit and re-enter the permanent simplified ETR safe harbor. This safe harbor, when satisfied, is expected to deem the top-up tax, including QDMTT top-up tax, to zero with respect to the jurisdiction. Given its expected application to QDMTTs, this new safe harbor will be relevant for US-parented multinationals as well as non-US parented multinationals, since US-parented groups remain subject to QDMTTs in the side-by-side system. In addition to this new permanent simplified ETR safe harbor, the transitional CBCR safe harbor has been extended for 1 year, with the 17% rate applicable for the simplified ETR test. In practice, this means that where a multinational group qualifies for the transitional CBCR safe harbor with respect to a jurisdiction, it could have an additional year to prepare for either the full GLOBE computation or the new permanent simplified ETR safe harbor computation.
Hello everyone, I'm Giorgia Maffini, and here is what you need to know about the Pillar 2 substance-based tax incentive safe harbor. This new safe harbor introduces a new category, an additional category of qualifying incentives called, very simply, qualifying tax incentives, or QTIs, applying for fiscal year starting on or after the 1st of January 2026. Two groups of incentives qualify under the new definition. Expenditure-based incentives, where the benefit is linked to the spend. For example, we are looking at R&D tax credits or super deductions. The second group of qualifying tax incentives is production-based incentives, where the benefit is instead linked to the volume of the output. So we are looking, for example, at incentive based on units produced or even emissions reduced, but not to incentives based on the value of that production. The new qualifying tax incentives do not replace the existing qualified refundable tax credits or the marketable transferable tax credits concepts, but they are different because mechanically the new incentives are added to cover taxes or simplified taxes, but they do not reduce globe income. The new qualifying tax incentives are capped according to the substance cap. The cap can be computed as the greater of 5.5% of payroll, or if greater, the depreciation of tangible assets, or again, if there is an election, 1% of the carrying value of tangible assets. So for U.S. inbound groups, the practical actions are three. First of all, produce an inventory of the incentives you're using by jurisdiction and try to identify which one could qualify as the new QTIs and which one instead could qualify as the old qualifying refundable tax credits or marketable transferable tax credits. Then model their effect on the ETR, always considering the substance-based cap, of course, and then track the implementation of the new guidance because the guidance is not self-executing but needs domestic legislation. I think the takeaway is clear here. The new QTIs, when they apply, they are able to reduce the cost of capital and so support investment and innovation, but the substance cap could reduce that benefit substantially, even though the benefit is likely to be larger and the cap is likely to be larger in large jurisdictions, in large economies where there is a lot of payroll and production footprint. And this is really a characteristic typical of the Pillar 2 architecture.